Star Entertainment has resumed trading after finally submitting its financial returns to the Australian Stock Exchange, announcing a $1.7 billion loss on top of a $2.4 billion loss from last year. Revenue has fallen by around 10%, and its Queen's Wharf development complex still requires another $350 million to be fully completed. On the 27th of September, they also responded to the show cause notice from the New South Wales Government asking why they should not be fined another $100 million for its continued responsible gambling and financial control safety failures. An agreement was reached with lenders to secure another $200 million in liquidity at 13.5% interest, and then trading did resume after a month-long trading halt, upon which 320 million shares traded hands, with the price plummeting from 45 cents, which was already rock bottom, down to a pitiful 25 cents after the day's trading. Now, despite having 3 major casinos in some of Australia's most iconic locations in near monopolistic conditions, Star Entertainment is now valued at less than $750 million for the entire company. By way of comparison, Crown was sold to Blackstone for $9.5 billion at $13 a share. And yet the biggest news, perhaps, is that negotiations with the stakeholder most interested in seeing Star succeed, the Queensland Government, has now failed. This would have seen major tax deferrals and other benefits, but because CEO Steve McCann and the other executive team were unwilling to forego using taxpayer-funded support for their own performance benefits, the talks collapsed. Now, in our last video, I mispronounced the new CEO's name, calling him Steve McMahon. It's Steve McCann, so I do apologize. However, perhaps by the end of this video, he'll be grateful for the earlier anonymity. Now, for just about everyone watching, it is going to seem beyond parody that an executive team responsible for cratering a casino company is refusing to save it because they want to use taxpayer money to feather their own nests rather than to support the actual business. And yet, perversely, McCann is doing exactly what is rational here. The real fault lies with Star Entertainment's board and the company's major equity investors. In fact, this is a wonderful test case of the cancer that is modern corporate culture and exposes the rot of CEO hiring practices. So welcome to Poker Room Review. I'm Crispin, and as Star Entertainment circles the drain, we answer the following questions. Why is it that CEO Steve McCann has refused a public bailout when it is so obviously in the interest of the company? What are the different kinds of CEOs and how are they remunerated? And what now for Star Entertainment, and can it possibly survive? If you haven't checked out our previous video essay on how Star Entertainment became one of the worst run companies in all of corporate history, we encourage you to check that out and come back. Suffice to say that the only friend Star seems to have remaining is the Queensland Government, who has an interest in ensuring that the Queen's Wharf development complex can remain open and saving the 1,500 jobs that are employed there. It is also critical that the 4 luxury hotels on site are able to accommodate the massive influx of people expected to support the 2032 Summer Olympic Games that will be held in Brisbane. In announcing the company performance, McCann himself has stated that, quote, "There are a number of significant challenges currently facing the business from an earnings, liquidity, and balance sheet perspective. This is an obtuse way of saying that Star isn't making any money." That's where the Queensland Government would have come in with support that is extremely far-reaching, enabling deferrals on payroll and gambling tax payments, and probably a lot of other things as well. Most importantly, it would have signalled to the market that the government is supporting Star and that the executive team were committed to doing everything possible to secure the company's future. Instead, this breakdown has cost McCann's own backers hundreds of millions of dollars in a massive market sell-off. Why did Steve McCann do this? Well, in modern corporate structures, there are 3 types of CEO. The first is the fail upward CEO, and these are by far the most common. Their main asset is not performance, but experience. These CEOs may have been fired from every position they've ever held, but have long resumes as company directors, and for many, That is the most important thing. The main reason to hire these CEOs is to signal to the market that the company is in a steady and experienced pair of hands and that not much is going to change. Their performance rests on not rocking the boat, with the most notable contribution being a seamless transition to the next mediocre body when they ultimately retire. However, sometimes these CEOs fail because the company they operate actually runs in a marketplace as well as a broader economy, and therefore actual leadership, believe it or not, is sometimes required. When this happens, a company can find itself in distress. This is not what happened at Star, of course. Their CEOs were actively incompetent and nakedly corrupt. But when a company is in freefall like Star, the board and major investors often look for what you might call a celebrity fixer, a corporate flavor of the month who specializes in corporate flips. These CEOs take a risk for a potentially massive reward. They're brought in as short-term miracle workers to come in, fire everybody, restructure the company they run, and once it's on a more stable footing, make the company attractive for a private equity buyout. And this is exactly what Steve McCann did in his previous job at Crown, where he took control of a casino in distress and a couple of years later sold it to Blackstone for what was a massively inflated price. For this, he received a $15 million award on top of his $2.5 million base salary, along with other benefits. An eye-watering windfall to be sure for the little time spent, and yet from the perspective of Crown shareholders, a really good investment. Indeed, it was some of these same major backers who openly admit now that this experience blinded them to the realities of investing in Star and hope to pull the same Houdini trick with them as happened at Crown. They again have brought in McCann to find a way to do exactly this, so far without much success. And that's because the priorities of these celebrity fixers are not identical to those of the board members. They aren't in the company for the interest of shareholders, but their own. CEOs like McCann don't really see themselves as CEOs. Rather, they're short-term investors themselves. Only what they're staking is reputational risk and time, but with the promise of big financial rewards if they can actually pull it off. McCann has absolutely no personal interest in the long-term sustainability of Star as an enterprise. His only interest is in convincing potential buyers of the company that it's a worthwhile asset so he can secure his performance-based reward of millions of dollars. If he's being asked to forego those incentives, he has no reason whatsoever to deliver the positive outcomes that would prevent the company from going under. Boards and investors who hire people like McCann simply do not understand this misalignment of interests, and sadly, this approach to hiring CEOs as celebrity fixers to achieve short-term rewards is basically the conventional wisdom today. What boards around the world seem to have forgotten is that the role of companies is to actually create value. And part of that value comes from providing goods and services that the market actually wants, and to do so in a responsible manner. With the failed negotiations and the collapsing share price, I expect the board and major equity investors will soon sour on McCann. But really, McCann is just doing what all celebrity fixers do. And so the board has no one to blame but themselves. And we can more vividly draw this contrast when discussing the third type of CEO, the dynastic inheritor. Intuitively speaking, you might think that the very worst and most incompetent CEO are those who simply inherited their major companies from their forefathers. After all, these people were just born with a silver spoon and did not acquire business qualifications or come up through cutthroat corporate culture or start successful businesses from scratch. And yet, all evidence suggests that the opposite is true. The strongest predictor of whether a CEO is going to be a major long-term success appears to be whether their parent ran the same company themselves. Now, some hypothesize that the reason is that children of CEOs of family-run corporate empires get an apprenticeship and years of on-the-job training that sort of no one else can really match. And while that's undoubtedly true to a degree, it also comes with some heavy drawbacks that should, in theory, lead to some catastrophic failures, but don't. Why is that? Well, my theory on this is perfectly illustrated by Star's contrasting example. Imagine this. You are the scion of a major company founded by your great-great-grandfather in 1850. You've been raised on the stories of your company history and its cultural contribution, not to mention the thousands of families and communities that have built up and grown around your company over successive generations. It is now your turn to take the helm. Your responsibility to ensure the company continues to grow and can be passed down again to your children and grandchildren. Now imagine that the company is in acute distress. It could be your fault. You could be the reason why the company goes under. The government, however, comes to you with a bailout that will save the business and enable you to make the changes necessary to safeguard its long-term future. All that's being asked in return is that you forgo your personal bonuses so that the taxpayer money that's used is contributing to the business and not yourself. How would you respond in that situation? I think we know the answer, and that shows why these company directors are so successful, because ultimately it is the long-term thinking and the direct alignment between a person's individual identity and the company goals that determine the likelihood of success. Any other approach is simply gambling, and the Stars board has proven time and again worse than their own customers in this regard. So finally, what do I think will happen to Star going forward? Well, there are two possibilities. First, Star can simply collapse as their interest payments become too overwhelming, revenue continues to dry up, creditors stop lending, regulars give up, and then ultimately the business just disappears. The other possibility can be viewed through the lens of Steve McCann's personal interest. First, it is likely that Star wishes to save the Queen's Wharf development complex at all cost, because it likely has the greatest long-term on-paper potential. Meanwhile, in New South Wales, the government justifiably despises Star, and compliance costs continue to mount for the Star Sydney Darling Harbour. With spiralling debt burden, the simplest way to stabilise the business would be to sell Sydney Star and withdraw operations from New South Wales. This would attract a hefty price and likely significant interest in potential buyers who don't have the same baggage when it comes to New South Wales state regulators. The funds raised would be a significant boon. It would pay off the most recent debt, those with the highest interest rate, and also allow the finishing off of Queen's Wharf. By putting all of its eggs in Brisbane and Gold Coast, Star can narrow its operational focus and ultimately achieve what McCann personally sets out to do, making Star an attractive concern for a buyout. Not exactly the approach the board might have in mind, but definitely very good for McCann himself. On balance, this seems the most likely. Anyway, that's my latest update. I'm going to be abroad for a few weeks doing reviews for poker rooms, so I'll see you when I get back. In the meantime, thank you for watching, and I will see you next time. Goodbye.